The market is currently closed, and Opendoor Technologies, Inc. closed at a price of $9.57 on Friday, September 19, 2025. That represents a significant drop of about 3.72% for the day. While the headline figure of a 3.72% decline might cause some to panic, the real story here is not in this single-day move, but in the incredible, near-parabolic surge that preceded it. This stock was trading at just over 50 cents earlier this year. It's now sitting at nearly $10 a share. That is a truly stunning run, and this pullback, while noticeable, is almost insignificant when viewed through the wider lens of the last few months. The most fascinating aspect of this rally is the narrative that has emerged around it. The common investor sentiment, especially on social media, has been that this is a classic meme stock squeeze, a rally fueled by retail excitement and a high short interest. This is the expectation. The reality, however, is far more complex and involves a fundamental restructuring of the company's entire business model, a new CEO from a high-growth tech company, and a controversial but decisive chairman. The market is not just buying a narrative. It's reacting to tangible, if still nascent, changes. This is the tension we need to focus on, the contrast between the simple, oversimplified meme stock label and the underlying strategic shifts that could genuinely change the trajectory of this company. The recent price action, including this small retracement, is a direct result of that battle between short-term trading psychology and long-term business fundamentals. The recent intraday movement for Opendoor has been nothing short of volatile. On Friday, the stock opened with a gap down and was unable to regain its footing, slipping from an open near $10.04 to close at $9.57. This kind of sharp negative movement on high volume, over 230 million shares traded on Friday alone, tells you that a lot of traders were taking profits. After a staggering run like the one Opendoor has had, this is completely normal. The institutional landscape is watching this closely, trying to determine if this is a healthy consolidation or the beginning of a larger sell-off. The short interest in Opendoor is still notable, and a portion of this recent activity could be short sellers covering, but the big money is also likely looking for an entry or exit point as the story evolves. You also have to consider the broader market context. We've seen a wave of optimism, particularly in the real estate tech space, tied to the belief that the Federal Reserve might be done with rate hikes and that the housing market could stabilize or even improve. This macroeconomic backdrop has been a significant tailwind for companies like Opendoor, which are highly sensitive to interest rates and home inventory. The Opendoor story is also intertwined with the rise of other names that have had dramatic recoveries, like SoFi. These companies are seen as being on the rebound, and that collective sentiment can lift the entire group. In this environment, a stock like Opendoor can gain momentum quickly. What's interesting is that insiders have also been active. There have been recent insider buys, including a significant purchase by a company director, which signals confidence from those who know the business best. This kind of activity can often provide a crucial counter-narrative to the just a meme stock belief. It forces you to ask yourself whether these people are buying into a delusion or if they see something real that the wider market is still missing. On the other hand, the reality of Opendoor's business model and its history is what makes this current stock price so difficult for many to accept. For years, Opendoor's core business of iBuying, or instant home buying, has been capital-intensive and often unprofitable. They make cash offers for homes, hoping to flip them quickly for a small profit. The problem is, when the housing market cools, they're left holding a massive depreciating inventory of homes. The company has bled cash, and its balance sheet has been a major point of concern. This is why analysts have a median price target that is wildly different from the current stock price, in some cases projecting a downside of over 700%. They are looking at the company's historical losses, its negative earnings per share, and the inherent risks of a cyclical business. The expectation, fueled by the new leadership and potential for an AI-driven pivot, is that this history is no longer relevant. But the reality is that the company still has to prove its new model can be consistently profitable and scalable in a way that the old one couldn't. This is where the tension lies, a stock price that has run up on a new vision, with an old business model still struggling to find its footing. You have to ask yourself, are you investing in the vision or the current financial reality? It's a question many individual brokerage account holders are grappling with right now. Even with the renewed excitement, the underlying business is still on shaky ground. It will take more than a new CEO to fundamentally change the unit economics of buying and selling houses. The new leadership, including new CEO Kaz Nejatian from Shopify and co-founder Keith Rabois rejoining the board, is the core catalyst for this entire rally. This is not just a standard C-suite shuffle. Nejatian is known for his work at Shopify, a company that has successfully built a software platform on top of a physical business. The new vision for Opendoor seems to be moving away from the capital-intensive iBuying model and towards becoming a software partner for the real estate industry. They want to provide services like their Cash Plus offer, which gives home sellers the convenience of a cash offer without Opendoor having to actually buy the home first. This would be a massive shift. It would move them from a high-risk, low-margin business to a potentially high-margin, low-risk software-as-a-service model. This is the expectation, and it's what has ignited the imagination of investors, especially those who follow tech stocks like Tesla stock and Nvidia stock. But there are significant challenges. The real estate industry is notoriously slow to change. Realtors are resistant to new technology that threatens their commissions. Building a robust software platform that can truly disrupt the industry will require immense capital and time. It's not an overnight switch. While the excitement is real, the execution risk is high. The company's recent announcement to expand its services nationwide is part of this new strategy, but expanding a new, unproven model carries its own set of risks. The market is betting on a seamless transition, but history shows that business pivots of this scale are rarely smooth. This is the reason for the massive divergence between the stock price and many analyst targets. Analysts are looking at the company's history of losses and a business model that has yet to be proven profitable at scale. They are not yet convinced that the new strategy is a sure thing. The market, on the other hand, is pricing in a high probability of success, a classic example of optimism getting ahead of reality. The future outlook for Opendoor Technologies is tied directly to the execution of this new strategy. The company has a narrow window to demonstrate that this pivot is more than just talk. In the upcoming quarters, investors will be watching for tangible signs of progress. We need to see how quickly they can scale this new software platform and what kind of margins they can generate from it. We need to see if their Cash Plus offer gets real traction with both home sellers and real estate agents. The biggest risk is that they fail to gain a significant foothold with the new model, while their old iBuying business continues to bleed. They would then be stuck in a difficult position, caught between a fading old model and a struggling new one. There are also macroeconomic pressures to consider. While there's optimism about rate cuts, the housing market is still under pressure from high prices and limited inventory in many areas. A prolonged downturn in real estate could put additional strain on Opendoor, even with its new model. This is the kind of detail that a quick search on an online investing site like Schwab Intelligent Portfolios or SoFi Invest might not fully capture. You have to read the tea leaves, listen to the earnings calls, and understand the nuances of the business itself. The opportunity, of course, is that they succeed. If they can build a profitable and scalable software business on top of the real estate market, the current valuation could seem cheap in hindsight. This is the big gamble that many retail investors and even some institutions are taking. The stock is a battleground between those who believe in the visionary leadership and the potential of an online investment pivot, and those who see a struggling company with a long history of losing money. The final word on Opendoor is a reminder of the core tension we've discussed: the expectation of a quick meme stock-style win versus the reality of a complex, difficult business transformation. The recent leadership changes and the focus on a new AI-driven software platform have created a powerful narrative that has driven the stock to impressive heights. The commentariat sees it as a new meme stock, a quick trade, a way to ride the momentum. The reality is that this is a company attempting a fundamental, high-stakes change to its business model in a very challenging macroeconomic environment. While the excitement around the new CEO and chairman is valid, the company still has to prove that it can turn a profit and manage its massive inventory effectively. This isn't just about a short squeeze. It's about whether the company can truly become a new kind of real estate technology platform.
The question isn't whether the stock will keep going up in a straight line, because it won't. The real question is whether the company can execute on its new vision, and that is a story that will unfold over the next several quarters, not days. We have seen these stories before, and for every success like Tesla stock, there are dozens of companies that failed to make the pivot. The recent pullback, however, small, is a reminder that the path forward will not be smooth. Comment below and let me know how many shares of Opendoor you currently hold and what your long-term price target is. Do you think the new leadership can truly change the company's fortunes?